Hello, everyone, and welcome to the Weekly Watch. I'm your host, John Briggs. It was another volatile week in markets headlined by the U.S. CPI report, which was much stronger than expected and has gotten the market speculating about a 100 basis point, a full 1% rate hike from the Fed at their July meeting later this month. This has raised expectations for a hard landing in the U.S., with fears the Fed will not just have to move faster when it comes to raising the policy rate, but also moving to a higher rate than previously expected. And further, these expectations have also continued to fuel the recession fire, where higher policy rates are causing expectations the Fed will push the U.S. economy into a recession, and in turn, more quickly than before. Indeed, market pricing for the Fed policy rate sees a peak now approaching 4%, but then the market is actually quickly pricing in cuts as soon as March of next year. While listeners know we have also harbored growth concerns along the way, we don't agree with the idea the Fed will cut that quickly. Much of this is based on the fact that by March of next year, we don't see inflation coming down as much as they would like, nor do we think the Fed will be so quick to cut based on any forecast that they have inflation coming down, because their forecasting of inflation has been poor at best in the last year. So they will need to see actual inflation coming down and to the pace that justifies cuts, no matter what is happening with growth. And that's a mix that's not only not good for growth, but for risk assets. Tighter policy that's relatively unresponsive to lower growth, which is a phenomenon we have not seen for more than a decade, in my view, why risk has been struggling lately, in addition to just the headline prints. Now, turning to the FX side of things, I'm going to bring in Paul Robson, our co-head of G10 FX Strategy. Paul, thanks for joining. Also in the news this week is the euro hitting parity versus the dollar within a backdrop of overall dollar strength. What's behind this? Why has the euro declined so much this week?
Well, I think just for euro dollar specifically, I think it is important to recognise that a large part of the decline to parity is that dollar that you quite rightly mentioned. If you look at the euro against a set of major currencies excluding the dollar, the currency is weak, but it's by no means very weak. So part of this is a dollar move. And if you think about the dollar is the only real safe haven currency that has a significantly positive carry. It's easy to see why people seek safety in the dollar rather than what they've done traditionally is move back into, say, the euro, Swiss franc, and the yen. So I think that's important. For the euro specifically, it's the same old story. It's about the sort of rising energy prices, worries about energy supplies, which has been very specific this week in terms of annual maintenance to key pipelines in Europe. And markets are just worried that when they end that maintenance, that the supplies do not get turned on again and prices start to rise. Now, there's an interesting discussion about game theory here about whether it's in Russia's interest to restrict supplies during the summer when demand is low, but when Europe is trying to build storage and supplies ready for the winter, or whether they wait to the winter when demand is high. So it's definitely something for markets to worry about. That plays into weaker growth expectations for Europe, and growth, I think, particularly at the moment, is important, and it just helps that relative growth story in favour of the dollar. There's also a balance of payments angle here. The balance of payments position in the euro area is becoming increasingly worse, and I think that weighs on the currency. And I also think there's another angle that markets might not be focusing on as much as they should, and this is the idea that maybe large European corporates who may be interested in buying euros at these levels, selling dollars, might actually be overhedged because demand has been significantly weaker than they had expected. So you're not getting the usual demand for euro dollar as we approach parity than perhaps we've done in the past.
So what can turn the euro around? Or is it just too much of a dollar story? Is it too much that this Ukraine-Russia gas story will linger? Is there any hope for the euro here?
Well, there's always hope. And I think it's just centered on the two things that I concentrated in those earlier comments. One is energy supplies in Europe. If that was to be a positive surprise to the market, then I think you get a knee-jerk reaction higher in the currency, but also in relative growth. You need some evidence that growth forecasts for the euro area have troughs. And if you look at how they are moving at the moment, they're actually getting worse. So over the last couple of weeks, the economists that supply forecasts to Bloomberg, their consensus forecasts, have actually weakened quite significantly. I think it's interesting that the euro has weakened both against sterling and the dollar when that has happened. So you need some sense that that's run its course. Neither of those sort of factors look like they're going to turn during the summer. Now, that said, as I mentioned earlier about the summer maintenance period for key pipelines in Europe, it's a 10-day maintenance period. It started earlier this week. It will be done hopefully by the end of next week. And if the supplies do get turned back on, then maybe you get a knee-jerk reaction. But I think for a longer-term base, you really need something quite positive on the supply outlook for energy in Europe. And unfortunately, that looks like it's going to persist for many quarters to come. But although that's a key uncertainty.
Yeah, interesting. And as I was talking about, like worries about recession in the US, if you continue to have even more worries about recession in Europe, your relative balance of growth there just doesn't help the euro very much. So lastly, what are the implications for sterling? Or is sterling just along for the ride here?
Well, I think a large part, I think it's the same with all European currencies, whether it's the Polish zloty or Sweden, Norway, they're all being tarred with the same bus. So this is a higher energy price, slower growth story. So the dollar is stronger against all European currencies. There is a couple of interesting narratives around sterling, which we continue to watch. One is the idea that we think that sterling dollar finds support around these current levels, around 120. Long-term buyers of sterling, whether for hedging or picking up cheap UK assets, looks like it's a theme, because what you've seen is as euro dollar has fallen, sterling dollar hasn't fallen quite as quickly, and it's pressuring the cross lower. So euro sterling, for example, is moving lower. So there is some idea that maybe sterling has been oversold at these levels. Also, in terms of growth, in previous comments, we've talked about how growth is very important for sterling, UK growth, because we run a current account deficit. You need to fund that current account deficit. And the way you do it is to have strong growth, FDI, portfolio inflows, which are important, and fiscal policy easing through the leadership election, Conservative leadership election. It feels like everyone is talking about tax cuts. At the margin, play positive for sterling. So the idea that sterling's holding up a little bit better than euro shouldn't be too much of a surprise. And we think that actually continues to be a theme through the rest of the summer.
All right, great. Thanks, Paul. Well, next week, the Fed's in blackouts, so keep an eye out for any Wall Street Journal leaks about the upcoming policy meeting as we debate whether they do go 75 or 100 basis points. For the UK, we're looking at UK inflation, see if the outsized rate hike story also spills over to Britain. And we have European inflation data as well, although as Paul notes, we're going to be watching this gas story probably even more closely than that. So stay nimble out there, and that's all we have for this week. Thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find it. Thank you very much. We'll talk to you next week.